Hi everyone, Brian here. Welcome back to the Cash Flow Desk. Today we're diving into inventory management, specifically how forecasting, costing, and cash flow all work together to keep your business running smoothly. If you've ever wondered why your cash gets tied up in products sitting on shelves, or why your profit margins seem to shift from month to month, this video is going to connect those dots. Here's the thing about inventory. It's both an asset and a cash flow challenge at the same time. When a retail business buys $50,000 worth of products, that money is locked up until those items sell. Poor inventory management means either running out of popular items, losing sales, or holding too much slow-moving stock that eats up working capital. The goal is finding that sweet spot where you have enough inventory to meet demand without tying up more cash than necessary. And that starts with understanding three key pieces: forecasting demand, calculating true costs, and managing the cash flow impact. Let's start with forecasting, which is really just predicting how much inventory you'll need and when. The most basic approach is looking at historical sales data. If an e-commerce business sold 500 units of a product last quarter, they might forecast 500 units for the next quarter, adjusting for trends or seasonality. But good forecasting goes deeper than that. You want to factor in lead times, how long it takes to reorder and receive new stock. If your supplier needs 6 weeks to deliver, you need to reorder before you're completely out. Tools like Inventory Planner or CN7 can automate a lot of this, pulling in sales data and calculating reorder points based on your specific business patterns. The key is being realistic. Overestimating demand ties up cash in slow-moving inventory. Underestimating means stockouts and lost revenue. Next up is costing. And this is where a lot of businesses get tripped up. The obvious cost is what you pay for the product itself. But true inventory costs include storage, insurance, financing, and even the opportunity cost of that tied-up cash. There are also different accounting methods to consider. FIFO, first in, first out, assumes you sell your oldest inventory first. LIFO, last in, first out, assumes you sell the newest stock first. During periods of inflation, FIFO typically shows higher profits, but also higher taxes. Then there's weighted average cost, which smooths out price fluctuations by averaging the cost of all units in stock. Manufacturing businesses using systems like Katana need to track even more: raw materials, work in progress, and finished goods, each with their own cost calculations. The method you choose affects both your reported profits and your tax bill, so it's worth getting right. Now let's talk about the cash flow piece, because this is where inventory management either helps or hurts your working capital. Every dollar spent on inventory is a dollar that's not available for other business needs. The longer inventory sits, the longer that cash is tied up. Inventory turnover is the key metric here. It measures how many times per year you sell through your entire inventory. Higher turnover means cash is cycling through your business faster. For example, a business with $100,000 in average inventory and $1.2 million in annual cost of goods sold has a turnover ratio of 12. Meaning they cycle through inventory once per month. Compare that to a business turning inventory only 4 times per year. Same revenue, but cash is tied up 3 times longer. This is where smart ordering strategies matter. Just-in-time ordering reduces holding costs, but requires reliable suppliers and accurate forecasting. Let's see how this works in practice. Take a SaaS company that also sells physical products, maybe branded merchandise or hardware. They use forecasting to predict seasonal demand spikes, cost their inventory using FIFO to match their accounting system, and monitor turnover to keep cash flowing. Or consider a manufacturing business using Katana to track raw materials and finished goods. They forecast based on customer orders and production capacity, calculate costs at each stage of production, and time their raw material purchases to minimize cash tied up in inventory. An e-commerce business might use CN7 to integrate their inventory data with sales channels, automatically adjusting reorder points based on velocity and lead times. The common thread is that successful businesses treat inventory management as a cash flow strategy, not just an operational task. Before we wrap up, let's cover a few common mistakes. The biggest one is ordering based on gut feeling instead of data. Emotional purchasing decisions, like stocking up because you got a good deal, can wreck your cash flow if demand doesn't materialize. Another mistake is ignoring carrying costs. That cheap inventory isn't cheap if it sits in your warehouse for 6 months, tying up cash and accumulating storage fees. And finally, not tracking the right metrics. Revenue growth is great, But if your inventory turnover is slowing down, you might be building up cash flow problems for later. So here's the bottom line. Good inventory management isn't about having the most stock. It's about having the right amount at the right time to keep cash flowing and customers happy. Whether you're using tools like Inventory Planner, Sin 7, or Katana, or managing things manually, the principles are the same. Forecast realistically, understand your true costs, and treat inventory as a cash flow decision. If this was helpful, hit like, subscribe, and let me know in the comments what inventory challenges you're facing in your business. Thanks for watching. I'm Brian, and I'll see you in the next one.